like to invite Pankaj Chopra, Vice President Taxation from Hindalco Industries Limited. Please welcome him on stage with a huge round of applause.
Good evening, friends. We are listening from morning on tax technology, GST, and many things. I will take you to the international taxation, treaties, and transfer pricing dynamics. My dear friend Varun has captured many things. I may not repeat the few things. So the objective of international taxation. What is the objective? It's an economic efficiency, because every country wants the tax. So they get tax to run the government, they want tax. The people should also have the money for their economic activities. National wealth maximization. Each country will have their fair share of taxation. Tax equity. So I should get the fair tax from each one. Whosoever is doing business with me should pay the tax. And balance capital export and import neutrality. Wherever I sell the goods, the tax should not be higher or low, it should be equal. The objective of DTAA to avoid double taxation, prevent tax evasion, allocate tax jurisdiction, because when two countries enter into transactions, each one wants fair share of their economic activities. Exchange of information, two countries entered into the treaty to share the data of their residents, and certainty of tax treatment for investors. Because when treaty provides some tax, it is a certainty that there will be no extra taxes on this. The treaties are now to be read with MLI, multilateral instrument. In 2017, many countries have entered into one single document which will override the treaties. And treaty have the principal purpose test. The most important thing now every international transaction will require is the business rationale. Treaty benefit to be denied if principal purpose to enter the transaction is to obtain the tax benefit. So any of the transaction between the two entities will require the business rationale. The PPT was introduced to prevent misuse of treaties, because there are many international jurisdictions which provide the very low tax or minimal tax, like Ireland and etc. They have very low tax. So with the introduction of PPT, there will be no double non-taxation. Earlier we used to say no double taxation, but with introduction of MLI and PPT, there will be no double non-taxation. The person will have to pay tax at one place. It will not go away without paying tax in any country. Align treaty benefits with genuine commercial objectives. So we need to have business rationale for the transactions. So one cannot enter into a transaction just to obtain the tax benefit. In old days, we generally used to have the tax conversation, how to save the tax optimization. But now the things has changed. Tax law is evolving, and now we think how could we simplify the tax, how the transaction should be done in a simplified manner, and without saving how we can save the tax. Strengthening global tax system against base erosion and profit shifting. As I said, people were generally having tax planning, put their actual transaction into the low tax jurisdiction and gain from the tax arbitrage. But now with the BEPS 2 coming in, which will have minimum tax of 15% in each jurisdiction, so it will avoid the base erosion and profit shifting. You will not be able to do transaction on tax arbitrage. Any transaction will require business rationale and robust documentation, because nowadays you cannot think of tax optimization without having your business rationale. If you have a strong business point, then only you can safeguard your tax saving also. Identify and quantify the business reason for any transactions. Choice of location of entity and this rationale. We cannot go and put our entity in a low tax jurisdiction without thinking of rationale or creating the substance over there, because substance over form will be major thing in going forward. Critically evaluate the evidence to assess the weight of business versus tax related purpose. So your business purpose will always prevail over your tax benefits. So whenever we have the strong business case, the PPT will support us in the transactions. Now DTAA to be read with multilateral agreement. So it will be called as synthesized double taxation avoidance agreement. In income tax website also if we see, we will find that there are many new clauses are entered and PPT is one of that. So that is called as covered tax agreement. So all DTAA will be called as covered tax agreement. We have to read with MLI whether it is satisfying the business case or not. We all think about like the tax law should be simple. We always say that Indian tax law are very complex, but I think more than the Indian tax law, the administrator needs to be simple. The way it is administered by the tax authorities, that needs to be simple, so it achieves the objective of simple tax in future. With regard to PPT, the CBDT has issued a clarification and guidelines that the PPT will be applicable prospectively. It is very welcome move, but there are various things which they have kept open. They said that the determination of PPT would be fact specific, case specific, so they have not given any guidelines except to say that with regard to Mauritius, Singapore and Cyprus, we will be giving the grandfathering. Whatever a transaction you entered before 1st April 2017 will be grandfather and you will get the tax benefit, but it will have to be seen on case to case basis going forward for any other countries. So even though you may satisfy the tax of principal purpose test PPT, but you need to see the one more ghost which is sitting in the Income Tax Act itself, which is general anti-avoidance. So GAR will always be available to tax authorities to apply on any transactions. तो दिस गार के रूप में जो एक भूत हमारे बीच में बैठा है, it can come any time and the department will take shelter of that and tax the transaction which has been done even though for the business purpose. There is one more subject which is talk of the day is concept of virtual CE. OECD is working on this. They are trying to tax the digitized economy, but with the Trump coming in, their all hopes has gone into vain, because Trump had outrightly said that Pillar 1 and Pillar 2 will not see light of the day in the US. So once US is strongly opposing the same, I don't know how European country will able to sail through the Pillar 2. Many countries has implemented Pillar 2 minimum tax of 15%, but India being a silent spectator on that, they have not announced in interim budget and also they have not announced in this 2025 budget also. So India is keeping silent, they are with US and not taking any steps to cover the BEPS Action Plan 2. Some important development in treaties. The Supreme Court ruling on MFN clause, most favored nation. Generally, two countries entered into a treaty which safeguard the interest that in future if you enter into any treaty and give more beneficial treatment to that treaty, then the same should be applicable to earlier treaty signed. But the Supreme Court in Nestle has held that MFN will not apply automatically. The government needs to issue a notification to that to apply the most favored nation clause. With this, the Switzerland which was taking benefit of MFN will not get the benefit. And to retaliate that, Switzerland government has also issued a notification that 1st January onwards, the Indian companies will not get the benefit of MFN clause. So this is something, I don't know whether we are moving away from internationally accepted principle or not, but it is not a good move, because once the two government align with on the something that we will give the benefit of MFN, the Supreme Court stating that you have to issue the notification to give effect to that, it is something which cause problem. and this will really, Switzerland has retaliated, and they have also removed the MFN clause for Indian companies. On account of Supreme Court decision, now CBDT has become proactive, and they have issued a notification with regard to India-Spain treaty. So with India-Spain treaty, they will get the benefit of lower tax on FTS and royalties, because in some cases it is 20%. With this notification, they will be able to take the benefit of 10%. The concept of economic presence, everyone must be knowing. Only one point wanted to bring to your attention, that with this, in this budget 25, they have harmonized the definition of SAP, and they said that the transaction activities of non-resident confined to purchase of goods in India for exports will not be covered under the significant economic presence. So this can be interpreted in such a way that if activities actually done by non-resident in India will not cover under the SAP, then the transaction which we do with the non-resident for import of transactions should not also be covered into the SAP, because non-resident is not doing any economic activity in India, so that shelter can be taken that whatever imports are there, they will not be subject to SAP, even if it reaches the threshold limit of provided in the notification. Transfer pricing risk mitigation strategies. So transfer pricing is always evolving era after 2000, once the TP provisions are introduced in the income tax law. It always evolving and thrust on the documentation. Whenever we do the transactions, we should know what transaction is that and how that can be substantiated, whether benefit tests are passed or not, whether actual services are received by the company or not. So those are the things or theme which we need to think, that transfer pricing strategies needs to be done at the time of entering into transactions and not the post facto, because many intercompany transactions are done at the procurement level. Tax team may or may not be involved. So we need to keep in mind and educate that procurement team that any transfer pricing provision we need to have documentation at the point of the entering into transactions. In this budget also, they have introduced the block years of transfer pricing evaluation. So we can request the TPO, make the application to TPO, and he will decide on that whether he can go for 3 years block assessment on transfer pricing provision or not. Advanced pricing agreement. This is really a game changer for any person. When a taxpayer and government, it can decide on how the transaction to be entered, because you know the pricing in advance, you have tax certainty. So there are good significant improvement in FY 23-24, where 125 APA has been signed by the government of India, which have given tax certainty. The disadvantage of that is that it is very time consuming process, because you may not get the answer in the year itself. It may take 2, 3, 4 years to determine to finalize the advanced pricing agreement. The government machinery is not there to do the fast processing of the APA application. So therefore there are a lot of applications are still pending, and it is a scope for improvement for government also, because it will help. If we decide the APA, it will boost the revenue also, because there is something which will be coming to Indian government. The APA provision should be time barred. Like in this budget, the FM have introduced that provisional assessment has to be completed within 2 years. Within the 2 years timeline. Similarly, the APA should also have the time to gain its importance and the tax certainty. The major important points which is the many MNCs are facing is intra-group charges, because intra-group charges is something which is head office expenses. Every company is doing something and operating from their head office. They have various common functions: treasury, risk management, hedging, CFO, the MIS, and etc. So this has to be seen based on the need test, whether these services can be taken from head office or not. why AE is taking from head office and not from any third party. Whether there is any tax advantage or any real benefit available to the company or not. If I take similar services from third party, how much it will cost. The receipt test also to be determined. We cannot say that I have taken a services of what you say is cable services which is available to all my group company, whatever channel you want to see, you can look into, but it is available to you. But in case of intra-group services, you need to establish the actual receipt of services and actual with the actual benefit test whether it is passing or not. Duplicative of services. There may be many functions which are duplication. Head office HR is there, at your local subsidiary also HR is there. So we need to substantiate how corporate HR is helping in distribution of services. Then that basis all these factors, we have to determine the cost factor and allocation, how it can be reallocated. One more aspect I wanted to discuss about when COVID was triggered in 2020, many people were stranded in India or maybe outside India wherever they were. So they were providing services from India only. The tax residency status in those cases must have breach of 180 days or so. So in those cases, OECD has given the guidance that exceptional and temporary changes in the location where employee exercises their employment will not trigger change in residency because it is an exceptional situation not in their hand. CBDT had also issued the circular to that, but in that CBDT said that you need to come to them to take the benefit of this. So with this, thank you very much for patient hearing. Thank you UBS Forum for inviting me for this here for presentation. Thank you very much.
Thank you, sir.